Imagine waking up one day and checking your investments and you realize you're down 78%. Not 7%, not even 8%. You're down 78%. Well, that's exactly what happened to me in May of 2022, which is also the month I realized I made a mistake when it came to IPOs.
There's a lot of lying in modern finance.
So you're not in favor of any of these big
I don't like lying.
An IPO, or initial public offering, is when a private company decides to go public by selling shares on a stock market. Investing in IPOs can be risky. A famous US investor, Peter Lynch, once said that IPO should actually stand for "it's probably overpriced." And there's some truth to that. But with high risk can come high reward. That's the whole premise of finance and investing. So are you really missing out on a sweet deal by not investing in IPOs? Or is there something else to the story? In this video, I'm going to share my experience buying a stock that was just listed, discuss why I'm never doing that ever again, and share some advice from experts like Warren Buffett.
And if you can't answer that question, if you can't write that out, then you'll go on to something else.
This is not investment advice. I shouldn't have to say this, but do your own research. But you don't want to miss this video. Alright, so the story starts in January of 2021. I was on social media and I came across an ad for free glasses. Now, I wear glasses, as you can see, and I was intrigued, but of course I was skeptical. I know there's no free lunch in finance, and so I read through the terms and conditions, I researched it on Reddit and on Google, and it turns out it was legit. All you had to do was pay $8 shipping, and you had a free pair of prescription eyeglasses just shipped to your door in 2 days for $8. So of course, after the research and after discovering it was legit, I signed up. Now, before I tell you what actually happened, let's go over the company behind the ad, Kits Eye Care. Now, Kits is a vertically integrated digital eye care platform that they say offers customers a wide range of high quality contact lenses and eyeglasses for a fraction of the price. And their focus really is this affordable glasses like Warby Parker or other competitors in the space. And this was true. 3 days after I placed my order, I got a box in the mail with actual glasses. And not only was the box cute, like it had a little message on it that was like "see the world" or something, and the customer experience was great, the glasses were actually good. I was able to see and they were medically correct. I took them to a store to even get that confirmed, but I loved the experience and everything panned out. And so my mind quickly went to, okay, this is awesome, not just because it was free, but it's a great experience and it's affordable. People will probably do the same in my position if they were exposed to this company. And this is when I dove into the investor relations part of their website. Every company that is publicly listed or that is looking to be publicly listed usually has one. It's where you have documents about financial information, financial statements. And so I click on this link on the Kits website as I am just bedazzled by their UX and amazing prices and what have you. And I discover that they are IPOing soon. I was like, what? This is the first time I'm excited about this specific company that is IPOing. Plus, it wasn't just the company itself. The market was due for disruption. There's a large Italian company called Luxottica that has almost a monopoly on eyeglasses. And that's really why, after doing research, that I discovered the prices for eyeglasses are so high. The materials in these things are really not that expensive. It's plastic, but what really drives the price up is the brand name, is this monopoly that this company had. So long story short, in January when they IPO'd, I was in. I invested and I was sold on the company and I was ready to hold and just have my money skyrocket. Here's where things take a turn. I'm not a day trader. I don't check my investment accounts like every day, but I was looking at this investment every week, every month, and things weren't looking too good for the Kits stock that I was so excited for. And I knew something was wrong specifically on August 2021. Overnight, the stock went from $6, which was already super low. Remember, I invested at $9. The stock went from $6 overnight to $3.4. That was dramatic. It was the biggest shift I had ever seen in any position I had ever had, and it seemed off. 2022 didn't help either, and the stock just kept going down and down since the IPO. End of May 2022 is when things got interesting. I had ended up with the scenario I talked to you about in the intro. Remember the whole imagine thing? Well, that's what happened in the end of May 2022. My stock position, my investment in Kits had plummeted down over 78%. That's right, 78%. I had woken up all calmly, checked my investment account like I do every now and then because I'm not a day trader, and I saw that I was in the red 78% on my Kits investment. Now, thankfully, I hadn't sold any stock since the IPO until then, but I'm not gonna lie, it was not easy to keep holding or to keep going. Like, you know, the general advice is to buy low and sell high. You know to never panic sell. This is what you're told all the time, but it was hard. These are also glasses. Like, I was wearing them every day, and so I had a constant reminder of what was going on with the investment because the glasses were on my face. And an important side note here, during all this stock price going down, I wasn't just worried because it was going down. Like, that happens, right? But it was also that the market was doing fine. You know, there wasn't any economic downturn, there wasn't a recession, and the sector that KITS is in, the sort of intersection of tech and healthcare and eyeglasses, like, companies in those sectors were doing fine. And so that's when I knew something was wrong, and that's when I started to ask myself, like, had I done something wrong investing in an IPO? Specifically, was I lied to when I was told I had to get in early and that was an advantage? So the answer was yes. Kind of. And before I get into the reasons why and what I learned and what you should take away from this video, let's just finish the story. So around 2024, the stock started going back up and it kept going back up and the momentum took it back to around where it was when I invested. It didn't get to $9 when I sold, but it was around $8.3, $8.5. And at that stage, I really wasn't thinking about like maximizing my profit. I just wanted out, and I wanted out as quickly as I could, and I wanted out with as little loss as I could get. And so at that stage, I had sold. So was this catastrophic? No, but this is where it gets interesting, and this is where you should start really paying attention to this video because it taught me a lot. It could have been catastrophic because it was an IPO. And let's get into why, what I learned, and what you should take away from this video. And I think the best way to do this is to hear from the expert first.
In 54 years, well, I don't think Berkshire's ever bought a new issue. I mean, the idea of saying the best place in the world I can put my money is something where all the selling incentives are there, commissions are higher, the animal spirits are rising. I mean, that's going to be better than 1,000 other things I can buy where there is no similar selling enthusiasm and the desire to get the deal done and extra commissions. That's the single best thing to buy on a given day.
Never bought an IPO.
Yeah, never bought one.
Yeah. How can it be?
They don't even call us.
KITS is a great company. I still love them to this day. I think they make great products. I think their experience is great. And I think they're still poised to do well in their market. The issue wasn't KITS. It wasn't a bad company. The issue was it was an IPO.
The best single thing to use your money for in a given day is something that they got everybody in the world out pushing it. You know, it just doesn't make any sense. I mean, I'm not saying that necessarily what we're buying is going to work out better, but there have to always be better things than one single issue.
IPOs are designed to benefit the sellers and not the buyers like you and me when we get excited about an IPO. It's like a well-marketed, high-priced product that is based on hype and that really has a lot of driving factors that are pushing the price up. The insiders that are selling their shares on the market, well, they know a lot more about the company that's being listed than you do. There isn't a track record of years and years of financial statements. From a value perspective, the people selling their shares, the owners of these companies that were private, they're trying to get as much cash as possible because of their years and years of hard work to get to the point of an IPO. And look, I'm not a genius, but I'm not stupid either. Like I had done research and a lot of analysis before deciding to invest in KITS, but it kind of wasn't even about the company. As a seller, you want to sell high. And as a buyer, you want to buy low. And so the incentives between investment bankers and the company owners, everyone involved in the IPO, their incentive was super different from my investor perspective and incentive, which was to buy low. And it's not just the information gap. There's a lot of marketing that goes into an IPO. When a new company is going from private to public, there's something called an investor roadshow that happens where investment bankers that are working on the transaction literally go from city to city advertising and marketing this new opportunity to investors. They also time it, right? Like they choose when market conditions are favorable for them to get a high price. If you are a founder of a company that's going public and you want to make as much money as possible on what you own in the company when it goes public, well, you're going to wait for the market to be good and ready and the economy to be favorable for a high price. And so really the odds are stacked against us as investors, especially as retail investors, when we get involved in an IPO. And so my takeaway from all of this and the general research that I've seen and the overwhelming evidence that I've seen really suggests that you're better off putting your money elsewhere. There are examples, of course, and there's a caveat to everything. There are examples, of course, of IPOs that have done really well, but there's overwhelming evidence that that's not the way to go. And with the risk you're taking in an IPO, there's just a lot of other opportunities where you can take similar risk, if not less risk, with just as high of a reward. I also took away from this experience the lesson of not stock picking. I can make a whole other video on this, and if you want one, please leave a comment down below, because there is a lot of evidence that shows that stock picking also underperforms other methods of investing and approaches. But these are two lessons that I took away that I think are interrelated. You know, I'm human, I'm an investor that gets excited about companies sometimes, and I might stock pick again in the future. But what I do know is that if I ever stock pick again, it will not be with an IPO'd company, because I've learned from my mistakes, I've heard from the experts, and I now know the truth behind how IPOs work. If you enjoyed this, it takes a lot of work to do videos like this. Please leave a like, leave a comment if you have a question, if you want to share your perspective, if you have an experience investing in IPOs. And if you like these kinds of videos, please subscribe. Have a great rest of your day.